Okay, guys, so we should start our lecture class. So we have been discussing about concept of microeconomics and about markets, about output, inputs, and all our discussion previously was based on assumption that both consumers and producers or buyers and sellers have a complete information about what happened. Yes, as I say, we assume that both consumers and producers or buyers and sellers have complete information about variables, whatever variables of production or the product themselves that they're going to buy. So in 2 days and tomorrow and next week lecture class in this topic 6, we are going to discuss something which is a bit different when we have an asymmetric information. So we are going to discuss the quality, uncertainty, and the market for lemons, asymmetric information, and adverse selection, and also a market signaling. And next week, we are going to discuss about the moral hazard and the principal agent problems, as well as asymmetric information in labor markets, efficiency, and wage theory. So what is an asymmetric information? Actually, it is a quite common word or concept that we deal in economics or even in our life. And here, what I say, basically, when we study previously, we assume that both sellers and buyers have perfect information about the product they are selling or buying or the import. But in this case, maybe a seller of a product would know more about the quality of its product than the buyer. That we call an asymmetric information. So we can see that what happens when some parties know more than others. For example, after graduating, you as a potential employee, you know much better about your capacities and capabilities of the work rather than the employer. So frequently a seller or a producer knows more about the quality of the product than the buyer. Managers know more about the cost, competitive position, and investment opportunities than the firm owners. So asymmetric information is a situation in which a buyer and the seller possess a different information about a transaction. Here we have a lack of complete information when purchasing a used car increases the risk of the purchase and lower the value of the car. And this example, for example, is very good to understand that asymmetric information. Usually, if you want to buy a used car, the owner of the car who wants to sell it has more information about the condition or the quality of the car more than you. He may paint it very nicely, it looks very good, but actually you don't know about the engine, about the performance of the car, you know, about other, equipment. So the buyer knows better than you. So you as a seller knows better than you. You as a buyer, in that case, if you want to buy a car, a second-hand car or used car, therefore you are increasing your risk of purchase because there is a possibility or probability that that car actually is not good quality, and therefore this is lower the value of the car itself. Also, the market of insurance, financial credit, and employment are also characterized by asymmetric information about the product quality. Those all of them are source of that asymmetric information. So we have an example, for example, of this, the market for used car. We assume that there is two kind of cars, high quality and low quality. And buyers and sellers can distinguish between the cars, and there will be two markets, one for the high quality and one for the low quality. So we have the first market for the used car. We have the high quality market with the supply. SH is the supply for the high, and DH is the demand for the high quality. And we have a low quality market with a supply L, which means that supply for the low quality market, and DL is the demand for the low quality market. So SH is the higher than SL because owners of high quality cars need more money to sell them. And demand of DH is higher than DL, demand of high quality, and demand of low quality, because people are willing to pay more for higher quality. So you can see here, this is the demand for high quality car, and this is the supply of high quality car, and here the demand for low quality car. So you can see the demand for low quality car will not interact with the supply of high quality car, because usually the supply of high quality car is maybe limited, and people with that price that they offer for that does not really reach here. So we can see only the demand of high quality car will intersect with the supply of high quality car, and we can see here the price of high quality car is 10,000 and the quantity is 50,000. And here for the low market, where we have the demand for the low quality car, DL, and the supply for low quality car, SL, they interact. And here you can see the price in the market is only 5,000 compared 10,000 for high quality. And also we assume that also there is 50,000 quality low quality car also sold. But now we will have some assumption on how this market it will work, and how the asymmetric information will cause, how we call it, market failure. So as we say, sellers know more about the quality of the used car than the buyers. And here, therefore, initially buyers may think the odds are 50-50 that the car is high quality. It means that buyer will view all the cars as medium quality with the demand. So in order to understand, I go to the graph directly here. So this is just now we have seen, right? So we suppose that, as I said, there's two kinds of used car available, high quality cars and low quality cars. And also we assume that both sellers and buyers can tell which kind of car is which. Is it good quality or high quality or low quality? Therefore, then, in this case, there will then be two markets. So this is the first market, high quality, in my left, and in my right is second market with low quality cars. So if we see in the part in my left, SH or supply of high quality is the supply curve for the high quality curve, and DH is the demand curve here. This and this. Similarly, in my right, we have SH, the supply for the low quality, and DL, the demand for the low quality. So here, for any given price, supply for high quality cars lies to the left of, you can see, of SL. SH go to the left, right? If we bring this, we put it here, the supply of low quality will be somewhere here. Why? Because owners of high quality cars are more reluctant to part with them and must receive a higher price to do so. Usually, put in that way, there is only few people, they will sell their car after only using it only for a few miles or 100 miles, or let's say only 1 year or 6 months, then sell it back. That is good quality car. But you can find so many supplies or so many people, they sold cars after 5 years, 10 years of usage. So the first one here, the sellers of high quality, they are assuming to get higher prices, and the supply of low quality, they are assuming to get lower prices. So as I say, the demand DH is higher than the DL, demand for low quality, same, because buyers are willing to pay more to get high quality car. So if you want to get high quality car, you're going to pay more, so your demand will be here on the upper, or in the higher position. So here in the figures also we see that the market price for high quality is 10,000 and the market price for low quality is 5,000 just now, and each market will sell 50,000. But in reality, if this happen, without that, because since we have, happens actually if we have full information or perfect information. Means that when you go to the seller, or they will issue to you this high quality, this low quality. But sometimes it's not that the scenario, where many people, they go and buy second car or second-hand car or used car, that they assume that it is good quality, but actually it turned out to be a low quality. So in reality, the seller of the used car knows much more about its quality than the buyer does. Because you as a buyer, you will discover the quality of the car you bought only when you drive it for a while, for 1 month, 2 months, or 3 months. So what would happen if sellers know the quality of the cars, but the buyer doesn't know? And here initially buyers may think that the odds are 50%, 50% that a car will be high quality. Means if you go to the market where sellers sell the second hand cars or used car, so you will take like gambling, 50-50. I will buy this car, 50% could be good, 50% could be not good. Why you do that? Because when both seller and buyers know the quality, 50,000 cars of each type are sold. This scenario, right? We say if each one has a perfect information and knows that the cars are good quality or not, then each market will say 50,000, 50,000. low quality cars will be sold at 5,000 and high quality cars will be sold at 10,000. But now when making a purchase, buyer therefore view all cars as a medium quality, because since we don't have information or asymmetric information in another case where the sellers knows more than the buyers, so the buyers will assume that I will get 50-50%, so I put it as a medium quality. So you as a seller, you put this assumption based on the perception that equal chance of getting a high quality or low quality car. So you will say, I will put it 50%, 50%. But of course, usually after when you buy this car, you will know if it is good quality or bad quality. So the demand for cars perceived to be medium quality, denoted as DM. So this is the DM. And you can see here, when buyers now perceive those cars, all of them, either it is bad quality or good quality, as medium, because they don't have the information. So he does not know if it is good quality or bad quality. So they perceive them as medium all. Okay. As this figure shows, these medium quality cars will sell for about 75,000 ringgit. You can see here 70,000 here, and also similar to here. Okay, similar, right? And again, however, if you can see the quantity sold for the high quality is only 25,000, and before it was 50,000, and for the low quality is 75,000. Means that sellers, when they assume that, because they don't have full information, that those cars are in medium, they will pay for 7,500 ringgit, but actually they will buy more low quality cars rather than high quality cars. So you can see fewer high quality cars, only 25,000, and more low quality cars will, which is 75,000, will be now sold. So then again, what happened as consumers began to realize that most cars sold, when you buy it and you drive it, you will understand the car that you bought actually is not medium, but it is low, because most of them, 75,000, they got low. Only 25,000 they got high quality. So that perception of people, they will assume that those second-hand car or used car sold actually are not high quality, but are low quality. So their perception or their perceived demand shift. From where it will shift? It will shift now from DM to DLM, that one that I show you. So the new perceived demand curve may be DLM, which means that on average, cars are thought to be of low to medium quality. Low to medium quality. However, the mix of cars then shift even more heavily to low quality. Why? Goes again to DL. Why? This is as a result, the perceived demand curve shift further to the left, pushing the mixed car even further toward low quality. And this why happened because when so many people start using the cars and they discovered that, because I will say that most of them, they got the low 75,000. So they discovered that this is low quality cars, but even not even a medium. So the demand will shift to the demand of low quality car shift to the right, so less and less, and therefore the price also will get down and down. So what happened when DL, the demand shift to DL, This shifting continues until only low quality cars are sold, and you can see at DL interact with SL, and it will be sold at 5,000, and 50,000 of cars will be sold. And in the right, in the left side here, we will have DL could not interact with the supply of high quality cars, and 0 car will be sold for high quality, and all cars will be sold at a low quality. So at that point, the market price would be too low to bring forth any high quality car for sale, because owners of high quality, of course, at 5,000 would not be willing to sell their cars at that low price, because that low price is for low quality. Since they know their cars is high quality, they will not sell it. And consumers, or since they don't have full information, they perceive that this good quality car or high quality car also it is low quality car, so that they will pay for only 5,000. In this 5,000 sellers, they will not sell it. So this is result in the only relevant demand curve will be DL, or demand for low quality. So this situation in this figure is very extreme. Actually, the market may come into equilibrium at a price that brings both at least some high quality cars, but here the fraction of high quality cars will be similar than it would be if consumer could identify quality before making the purchase. But here is the problem: how we are going to identify the quality before making a purchase. So that is why you should expect to sell your brand new car, which you know is in a perfect condition, for much less than what you paid for it. For example, if you see some people, when they just bought the car brand new, after only a few months they want to sell it, you will find 30 to 40% of the market price of the car already gone. Because of asymmetric information, low quality goods drive high quality goods out of the market. People have this perception: why you want to sell it? Sure, there's something wrong with it. Maybe even they think that, oh, is this car, lemons? Lemons means that, or is this car, what we say, doesn't have, what we say, a legal papers, or maybe it is a stolen car and was smuggled or whatever. So a lot of questions come to people before making a decision to buy this car. Why this person, after a few months buying this car, want to sell it? So this phenomenon, which is sometimes referred to as I said, the lemons problem, is an important source of market failure. And what does mean lemon problem? Means that with asymmetric information, low quality goods can drive high quality goods out of the market. And this concept actually is known from the beginning, even from the money. Now, if you study the progress of the money, when it was made by only gold, then after silver, then after we will have metal, then after we have paper, which has a name only. And for that, now we have an inflation. Before we don't have these nominal notes or paper or money. We don't have inflation, because the money is the money. The gold price is there. When you have, for example, 1 ringgit, which is a piece of metal, which is a gold, the value does not reduce over time. But now, since we have papers and names, then we have that inflation. That's why the good money, drive out of the market. The bad money drive out of the market the good money. So this is how this from how high quality cars from being sold at 10,000 and 15,000 to being sold to zero quantity because of this perception. This is we already done explanation. Maybe if you want to repeat again, low quality goods drive high quality goods out of the market, which is the lemon problem. The market has failed to produce mutually beneficial trade. Too many low and too few high quality cars are on the market. And here we talk about the adverse selection. The only cars on the market will be low quality cars, a situation in which less desirable buyers or sellers are more likely to engage in a market exchange than more desirable buyers or sellers, because buyers or sellers do not have sufficient information to determine the true quality of the product being exchanged. So we are going to talk about this adverse selection. So our used car example, just now we showed that, as we say, the how asymmetric information can result in the market failure. So market failure arises in this example because there are owners of high quality cars who value their cars less than potential buyers of high quality cars. So in this case, both parties could enjoy gain from trade, but unfortunately, buyers' lack of information prevent this mutual beneficial trade from occurring. So put it in that way, if I have high quality car and I value it, for example, suppose it is 100,000 this car, but I just value it is 80,000. And I ask, okay, you want to buy 80,000? You don't want to buy because you don't have full information like I have. Even I tell you it's good quality car, you still suspecting why only 80,000, but the market price is 100,000. So you always suspect that, and therefore that will prevent for this mutual trade to happen. Even though I really want to sell it at 80,000, but you still cannot buy it because you still suspect on that. So the adverse selection occurs, and in this scenario of the used car, which is very simplified illustration of an important problem that affects many markets, what we call it the problem of adverse selection. What is it? Adverse selection arises when products of different qualities are sold at a single price because buyers or sellers are not sufficiently informed to determine the true quality at the time of purchase. And therefore, that what happened, too much of low quality product and too little of high quality product are sold in the marketplace, as just now we see in the graph. So we can see other examples, for example, the market for insurance. Market of insurance also, we will have this problem of adverse selection. You may ask yourself, for example, why almost always those elderly people above 60 years always find difficulty to buy medical insurance? Because, you know, insurance companies, they always worry. Usually, if you are elder, then you have high probability or high risk of getting sick. So other people do have much higher risk of serious illness, but why doesn't the price of insurance rise, to reflect the higher risk? In this case, if they have higher risk, why these insurance companies give different rate for those people? So the reason is the asymmetric information, because people who buy insurance know much more about their general health than the insurance company. If you want to buy insurance or health insurance, actually you know much better than the company. You know actually, because it's your body, if you are in good condition or no. So as a result, therefore, the adverse selection arises, much it does in the market for used car. The company does not have full information about the health conditions, but you have better information. So because unhealthy people are more likely to buy insurance, if you think that you are not going to get serious sickness, why you have to spend, for example, every month 400 or 600 to buy health insurance? You are not going to use it. But those people who know that their health condition is not that good, and they are expecting they may get serious illness, when they get older. So they have high probability to buy this insurance. So the proportion of unhealthy people in the pool of insured people will increase, since those people who knows that their health condition is not good, they will buy more insurance. Those people who know that their health condition is very good, they will buy less insurance. Therefore, in the pool for that insurance will be more people, what we call them so-called unhealthy people, who buy more insurance rather than the healthy people. So in that case, this forces the price of insurance to rise, because insurance company in that case, if so many people claim, then it must rise the premium, otherwise they cannot sustain. So more healthy people aware of the low risk elect not to be insured, and this further increases the proportion of unhealthy people among the insured, thus forcing the price again of the premium of insurance to go up and up and up. So the process continues until most people who want to buy insurance are unhealthy. Not say all, but most of them, maybe 80 to 90%. At this point, insurance becomes very expensive to, or in extreme cases, the insurance company will stop selling the insurance, and it is happened. I'm telling you, it is happened. Some companies here in Malaysia, I don't want to say the names, that come to one point where they stop selling of that, because of that they provide some insurance or some policies which was that really with low premium. Then after they want to increase the premium, people they don't want to buy, then that company stop of that program. So adverse selection can make the operation of insurance market problematic in other ways. For example, we assume an insurance company are targeting a certain population, males under 25. Okay. And it estimates that the probability of an accident for people in this group is only 0.1% as a rate. So this company, they know some of the males have low probability of getting an accident, and some have a high probability. If this company or insurance company cannot distinguish among insured, it will base premium on the average experience. Some with low risk will choose not to insure, and will rises the accident probability and rates. So a possible solution to this problem is to pool risk. But before I talk about that, I explain to you. So this, for example, this company targeted this under 25 years. Okay. And let's assume that after calculating the average of probability of having an accident, this company found it is 0.01. But again, you have to understand that this probability of having an accident is much less for some others. Maybe is less than 0.01, maybe 0.001. But others may have much than 0.01, but in average is 0.01. So what happened here, if the insurance company cannot distinguish between the high and low risk, okay, man, it will base the premium on the average accident probability of 0.01 only. And what will happen here, those people with low probabilities of having accident will choose not to buy insurance, while those with high probabilities of having accident will buy insurance. So this turn the probability of having an accident to rise, because those who have low probability of having accident will not buy. Only those having higher probability of having accident will buy. So the probability of having accident will increase or will rises from 0.01 maybe to 0.1 or 0.2. So this is increased, as I said, the rises the accident probability among those who choose to be insured above 0.01, and this is will force the insurance company to rise its premium. And in some extreme cases, only those who are likely to be in accident will choose to insure, making it impractical to sell insurance. Of course, if only those people who really, we can say, are certain to have an accident because of the way of they drive, they buy insurance. Therefore, the company, if the company sells the insurance, will lose money. Everyone will claim. So what is the solution now here? The solution to this problem of adverse selection is to the pool risk. For example, for the health insurance, the government might take on its rule for that. And for example, government provide insurance for all people above 60. For example, government will say, everyone above 60, I will insure it. So in that case, therefore, those who are above 60 will not buy the insurance from the private. Only those who are less than 60, they could buy. And then in that case, that problem will be solved. So by providing insurance to all people over 60, the government eliminates the problem of adverse selection. Likewise, insurance companies will try to avoid or at least to reduce the adverse selection program by offering group health insurance policies at places of employment. For example, in Utah, we are covered by insurance. So the Utah paying for us that pool. So when come to the workers, we have some people are over 60, so they are insured in that pool. Some of us are in health conditions. Some of us, even they are young, but is not good in health condition. Some of us are elderly. So it is a pool. And therefore, the risk will be diversified and the company will not collapse in that scenario. So insurance companies will try to avoid or at least reduce the adverse selection by offering a group health insurance policies at places of employment by covering all workers in a firm or a company, whether healthy or sick. The insurance company spread the risk and thereby reduces the likelihood that a large number of high-risk individuals will purchase insurance. So the risk will be spread. So for the now we go for the market for credit. So again, by using credit card, many of us borrow money without providing any collateral. So you just go to the bank and ask them, give you a credit card, they will give you. So most credit cards allow the holder to run a debit for several thousand of ringgit, and many people hold several credit cards. So credit card companies earn money by charging interest rate. But so many people, after they use the credit, they cannot pay that interest rate. Some of them they can pay back the interest rate. So now the bank cannot distinguish between what we call them high quality borrowers and low quality borrowers. High quality borrowers, those who can pay back. Low quality borrowers, those who cannot pay back. So this is what happened. Clearly, the borrowers have better information, means that you, when you borrow money from the bank, you know more about yourself, if you are going to pay back or no, if you are going to pay back on time or no. Again, here the lemons problem arises because why? Low quality borrowers are more likely than high quality borrowers to want credit, which forces the interest rate to go up. This, I tell you, this story happens when I was student. One day I was doing my work in the office beside my supervisor when I was doing my PhD. Then he got a call from the bank offering him a loan of 1 million ringgit. He didn't ask, the bank just called him. That guy, because he was Dato, he was very rich. When they see the record, they just want to give him, because they know that this is a high quality borrower. If he borrow from them, he can pay based on his salary. But of course, my supervisor, I hear him saying, no, I'm not interested. After I asked him, what is it? And he told me the bank offer me. He asked me, see, those people who have money, they have better chances to get money from the bank. So you can see, because he has money, he does not need a loan. But the bank still want to give him money because consider him as high quality borrower. But in reality, actually, people like us, maybe we don't have money, we are more likely to go and borrow money from the bank. For example, in your scenario, as a student, most of you have loan to continue your studies. Some of students, they cannot pay and blacklisted and they cannot go out of Malaysia. And this is, a reality. Some people, they buy cars and they cannot pay back. So the bank will chase them and take the cars, suspend the cars and sell it as an auction. Some people, they cannot pay the house also. So this is the lemon problem is happen, where those low quality borrowers will chase out the high quality borrowers from the market. So in fact, credit card companies and banks can to some extent use computerized credit histories. And this is what they did to my supervisor. They check the history that before he has a loan, he paid back on time. Suppose the loan to be paid in 5 years, he paid in only 3 years. So these computerized credit histories, which they often share with one another. The banks will share this information because some of us will borrow from CIMB, then after borrow from my bank. So win-win situation, they will share this information, so they will distinguish between a good quality borrowers and the low quality borrowers. So many people, however, think that computerized credit histories invade their privacy, and should companies be allowed to keep these credit histories and share them with other lenders? So we are not going to discuss about that, but it's happened. Some people, they feel that bank should not reveal, which is true because it's privacy. Even to another bank should not reveal, but actually banks do it in order to secure themselves from lending money to the low quality borrowers. They share this type of information. So we have also this asymmetric information and daily market decisions. We have retail sales. For example, you may ask, will the store repair or allow you to return a defective product? The store knows more about its policy than you do about that. Also, we have those antiques, art, rare coins. Are the items real or counterfeit? So the dealer knows much more about it if you want to buy those antique things from a shop. So he give you a piece and we say, oh, this is an antique, cost 50,000. But you always keep, is it that really original or maybe a fake one? Home repairs, it's happened. Last time I called someone to go up to the roof to repair, but I cannot climb. I don't want to take a risk to climb. It is his work, but for me, I don't take a risk to climb. But here now, is that, for example, when a roof repair or renovate the roof of your house, do you climb up to check the quality of the work? Actually, I don't know. I call so many people. Last one also, he did for me in electric, what we say, connection on the roof. So I don't know what quality of wires he used. So there is a risk. This is asymmetric information. the repairman, he has the information. You know what he has done. Me, I don't know. Restaurant, for example. How often do you go into the kitchen to check if the chef using the fresh ingredient or no? So you don't know. In all these cases, the seller knows much more than about the quality of the product than the buyer does. Unless sellers can provide information about the quality to the buyers, low quality goods and services will drive out high quality ones, and there will be a market failure. In this case, we say sellers of high quality goods and services therefore have a big incentive to convince consumers that their quality is indeed high. So for example, in example cited this above, the for example just now, this task is performed largely by reputation. So you shop at a particular store because it has a reputation for servicing its product. You hire a particular, for example, repairman or a plumber because they have a reputation. You go to a particular restaurant because it has a reputation of using a fresh ingredient and nobody has got sick. For example, nowadays, Lazada, Shopee, here when you shop online, they are allowing us, for example, to rate and comment on the product we purchase. And that rating, actually, I myself, when I go to buy from Lazada or from Shopee, I always go first and read about the comment about the product. People before me, they bought. That is reduce the asymmetric information because now I have full information. If those comments are not there, what happened? I will buy the product. I don't know the quality of the product. But once people before me bought it and use it for a few months, then they comment, then you will know that if the product is really in good quality or no. So those, for example, if you are driving, for example, in a highway from Penang to Kuala Lumpur, and you will stop in those R&R, and I will tell you a story about that later. So those R&R usually, maybe you don't know which stall that has a good quality food. And before them, for example, we assume there is a McDonald's or a KFC. So most of us will go to KFC or McDonald's or Burger King rather than the stores because why? You will know that KFC and McDonald's, they will have the same quality, even though it is in the highway where people usually, the customers are not the same. But McDonald's and KFC, the ingredients are the same, the quality of the burger is the same. So we are sure that at least when you take McDonald's is the same of other McDonald's. One day when I was doing my PhD, I was working in a hotel. So there is one guy there, he has an Eastern food restaurant. Then I saw him, of course I know him, he's my friend. Then I saw him that he does not that really care about the quality of the food or the taste. Then I asked him why it is like that. You know, you have some of your customers complain about the taste. Why you didn't talk to the chef? So he told me that secret that time, and which is that applicable for us now, right? Asymmetric information. He told me like that, all my customers are tourists because in the hotel, so only tourists, foreigners, they go and eat there. And most probably everyone come to eat maximum. If he really like my food, he eat 2 times, not more than that. Most of them, they eat only 1 time. They try the food because when we go for, I myself, when I go and travel, I try to try different type of foods, right? So I don't eat in only one place. So he told me in that scenario why I should spend more money to increase the quality and to enhance the quality of food. So they will just do the design very nice, you know, the decoration, but the taste is not good because they know that once the person order eat 1 time, he will not come back. But if let's say your restaurant is located in nearby companies, and your customers all almost are the same every day come to eat, then therefore you really will be concerned about the quality of the food and the taste. Because if the quality of the food is not good and taste is not good, those people will not come and eat with you, and you will not have customers. We're back. So this is the application of asymmetric information, I would say. So how can producers provide high quality goods when asymmetric information will be derived out high quality goods through the adverse selection? As I said just now, by reputation, when we took the case of Shopee and Lazada, or about any restaurant, the case of Shopee and Lazada, you will know the reputation of those sellers of product because of the comment provided. Users or buyers, when they bought before you, they comment on the product, they will give the rate. Restaurant, for example, that serve a good quality of food, and people spread that information. And also we have standardization, where the chains that keep production are the same everywhere, like McDonald's, Burger King, KFC, Nando's, Kenny Roger, or whatever. So this is McDonald's. As we just now we say, you look forward a Big Mac when traveling, even if you would not typically buy one at home because you know what you to expect from this Big Mac. Holiday Inns one advertise no surprises to address the issue of an adverse selection. Now we go to another topic which is very important, which is a market signaling. Actually, this is always, as an academic advisor, I advise my student or my advisees about that when I see some of you, they are not really working very hard to get a high CGPA. So your CGPA is a market signal for your productivity, for your reputation, for your. So as an employer, I don't know you. So when you bring your CV, I will say that you have a bachelor degree, but there's so many of you have bachelor degree. So how I'm going to select? I will take James, or I take Lee, or I take Chin, the CGPA. CGPA, higher CGPA will tell you so many things. You tell me about you that it's a signal. We tell you about you that you are smart, you are punctual, you are hardworking. Lower CGPA will tell me also that maybe you are not too much smart, you are lazy, you are not responsible, you know, you are not punctual to the classes, always missing your classes also. So this is a signaling. So be very careful before I start talking about the market signaling. So be very careful about your CGPA, because after you finish your bachelor degree, your CGPA will be the market signaling. So the process of sellers using the signals to convey information to buyers about the product quality. For example, how do workers let employer know they are productive so they will be hired? So weak signals could be dressing well. Is weak because even unproductive employees can dress well. I mean that is a weak signal. You go and put tie, very nice dress, that is weak signal. Even someone is unproductive, he can dress very smart or even much better than someone may be productive. So strong signal is to be effective, a signal must be easier for high quality sellers to give than the low quality seller. For example, high productive worker signal with educational attainment level. If someone has a PhD, that should be high quality rather than if someone has only a bachelor degree. Between bachelor degrees, just now I say, if you have a bachelor degree and there are so many also has bachelor degrees, so in this case, who define you that you are high quality or highly productive than your friend, your CGPA? So we assume that there are two groups of workers. Okay, group one, which is low productivity, average product and marginal product is equal to 1. Group two is high productivity, average product and marginal product equal to 2. So the workers are equally divided between group 1 and group 2, and therefore the average product for all workers is 1.5. If we put them together, 2 plus 1 equals 3 divided by 2, 1.5. So I will skip all the explanation. I go straight to the graph. Then we understand the concept. Yeah, here. So this is the two workers or two groups. Okay. So as I said, let's us assume that there are only low productivity workers, which is group 1, whose average marginal is 1, and high productivity workers, group 2, whose average marginal product is 2. And workers will be employed by competitive firms whose product sells for example, 10,000. The product sells for 10,000 ringgit. And who expect an average of 10 years work from each employee. So it means that this firm, before employing you, expecting that you're going to work for the firm at least 10 years. So we also assume that half the workers in the population in group 1 and the other half in group 2. So we divide by 2. So that the average productivity of all workers is 1.5, as just now we see in the first slide. So note that the revenue expected to be generated from group 1 workers is how much? Supposed to be 100,000. Why? Because group 1 is paid 10,000 only. Just now we assume. Okay, we say that workers will be employed by competitive firms whose products sell for 10,000, right? So 10,000 times 10 years, it will give us 100,000. Group 2 will be how much? 200,000. Why? Because the marginal productivity is what? 2. So the price is 10,000 times 2, 20,000. 20,000 times 10 years, 200,000. So that firm expecting from the low productive workers 100,000 and expecting from the high quality workers is 200,000, 200K. This is the high, this is the low. So what we say now, if firm could identify people by their productivity, they would offer them a wage equal to the marginal revenue product. Means that group 1 people would be paid only 10,000 per year. Group 2 people will be paid 20,000. This is because the firm knows their level of productivity. It is high or low. But on the other hand, if the firm could not identify productivity before they hired people, so they would pay the workers on annual average equal to the average productivity, which is 20 plus 10 equal 30 divided by 2, which is 15. So they will not pay separately because they don't know if you are high productivity or low productivity worker. So you do the average. How much the expenses? So at the expenses of group 2 people will be earning only 15,000 instead of 20, because group 2, which is high productivity, suppose they earn 20,000 because their productivity is 2 times 10,000 of the price of the product will be 20,000. But since the company cannot distinguish between them, it will give them the average. So group 2 will be paid only 15 instead of 20. But group 1 will gain, because group 1, which is low productivity, suppose it will be paid only 10,000. The price is 10,000 times the marginal revenue is 1 equal to 10,000. But actually, because the company cannot distinguish between the high and the low, they are now getting paid 15,000. So their wages increase. Now let's consider that what can happen with signaling via education. Okay, so suppose all the attribute of an education, degrees earned, grade point, or a CGPA, etc., can be summarized by a single index Y. So how many years of schooling, how many years CGPA, we put an index and put it Y. This Y, or this index, represent years of higher education. All education involve a cost, and the higher the educational level Y, the higher the cost. So the cost includes tuition, books, your opportunity cost of foregone to wages because you are studying, and the psychic cost of having to work hard to obtain high grades. Sometimes you are stressed, sometimes you are depressed. So the question, what is important is that the cost of education is greater for the low productivity group than the high productivity group, which is correct. Actually, low productivity group, they need more cost in order to get a higher education. They need to study more, they study harder, they may have to have tuitions. So we might expect this to be the case of two low productivity workers may progress more slowly through a degrees program. In particular, suppose that group 1 people, the cost of attaining education Y is given by C1 Y equal to 40,000 times Y. Okay, this is group 1 of getting education. And this is group 2 of getting education. The cost is C2Y equal to 20 or 20,000 Y. You can see group 1, low productivity, has higher cost of attaining education. Group 2 of high productivity has lower cost of attaining education. Now also we suppose, to keep things simple and to dramatize the importance of signaling, we suppose that education does nothing to increase one's productivity. We assume that even those people who get in education, actually education does nothing to increase the level of productivity. It only value is as a signal. Means that me as an employer, when I see that you have a higher education, I assume that you have a higher productivity. But actually, the education, we assume it does not. We assume for simplicity, but actually it will increase. But we assume that education does not increase the level of productivity, but it's just a signal. So now let's see if we can find a market equilibrium in which different people obtain different level of education, and in which firms look at education as a signal productivity. So equilibrium, we consider the following possible equilibrium. Suppose firms use this decision rule. Anyone with an education level of, let's say, Y star, okay, maybe here, this 4, or more, is a group 2 person and is offered a wage of 20,000. So anyone has Y star, this Y star, later we determine it, now in this case 4, and above, that means has level of education degree, like your 4 years degree, 4 years bachelor degree, or 5 years or 6 years and above, year of college. 4 years is degree, 5 years maybe master, 6 years maybe PhD and above. then this firm will consider that person with a high productivity and pay him 20,000. If it is below 4 or below Y star, we'll consider it as group 1, which is low productivity, and will be paid only 10,000. We assume that rules. So the particular level of Y star that the firm choose is arbitrary. Why? But for this decision rule to be part of the equilibrium, firms must have identified people correctly. Otherwise, the firm will want to change the rule. Will it work or no? So in order to answer this question, we must determine how much education the people in each group will obtain. And this given that firms are using this decision rule. So to do so, remember that education allows one to get a better paying job. And this is true. After you finish your bachelor degree, you will be pay much better than someone doesn't have a degree. So the benefit of education, which is BY, is the increase in the wage associated with each level of education. The more education you have, your benefit will increase. And you can see here it was 000 BY, the increase until 100K, then stagnant there. And here it was 000 increase to 100K, then stagnant here. Okay, later I will explain to you why it is like that. So you observe that BY is 0 initially, which represent the 100,000 base 10 years. Yes. Okay. This 100,000 base 10 years earning that are earned without any college education. Because if you don't have education, the firm consider you as you are group 1. So we will pay you 10,000 or 100K in 10 years. For an education level less than Y star, BY remains 0. Because 10 years earning remains at 100,000. Okay, yeah. But when the education level reaches Y star, okay, the optimum choice Y star, or greater, more than 4, for example, 10 years earning will increase to 200,000, increasing BY to 100,000. So BY now increased by 100,000 and become the salary is 200,000. Here the BY is 0. That means the salary is only 100,000. Sorry, 100,000. If the person does not have an education, the firm will pay him 100,000 per 10 years or 10,000 per year. So if the person got Y star, which is 4 years here, then the person will shift from this 100,000 per year to 200,000 per year. So means that the BY equal to 100K, the difference. How much education should a person obtain? Clearly the choice is between no education, 0, and the education level of Y star, which is here 4. Why? Because any level of education less than Y star result in the same base earning, which is 100,000. So if you get 3 years university, you still be paid 100,000. Then why you have to get 3 years? Better you don't get at all, because even you don't get at all, you will get 100,000. But if you get 4 years, then will be your salary or your wage 200,000. If you get 5, the salary will be also 200,000. So for why you want to go to 5, you will start only 4, because if you go to 5, your cost of education will increase. Thus, there is no benefit from obtaining education at a level above 0 but below Y star. Similarly, there is no benefit from obtaining an educational level above Y star because Y star is sufficient to allow one to enjoy a higher total earning of 200,000. This is all we explain. So now I go and explain to you about the cost. How much education to choose is a benefit cost analysis. So here the goal is to obtain the education level of Y star if the benefit increase in the earning is at least as large as the cost of education. So in deciding how much education to obtain, people compare the benefit of education with the cost. And this is usually what we do for any project. People in each group make the following cost benefit calculation. Obtain the educational level of Y star if the benefit, i.e. increase in earning, is at least as large as the cost of this education. So for both groups, the benefit or the increase in earning is 100,000. The cost, however, differ because each group, when obtain education, we may change from 100,000 to 200,000. 200,000 will stagnate there. So the cost is different for group 1. The cost is 40,000. Why? If you go 1 year, it's 40,000. 2 years, it's 80,000. 3 years, 120,000. 4 years, 160,000. Group 2 is only 20,000. Why? That's mean 1 year, 20,000. 2 years, 40,000. 3 years, 60,000. 4 years, 80,000. So with that, we say that Group 1 will obtain no education as long as this 100,000 is less than 40,000 Y star. And if we put this, means that Y star should be greater than 2.5. If you put Y star at 2.5, we will get 2.5 times 40,000, we will have 100,000. So if Y is greater than 2.5, therefore this will be greater than 100,000. Group 2 will obtain education if 100,000 is greater than 20,000 Y star, therefore Y star should be less than 5. If it is 5, it will be here 100,000, it will be here 1,000. That means he doesn't benefit. What he gain, he spent. So the result given will give us an equilibrium as long as Y star is between 2.5 and 5. But suppose, for example, that Y is 4, as we see here in the figure. So now we put 4, right? If it is Y 4. In this case, people in group 1 will find that education does not pay and will not obtain any. Why? Because 40,000 times 4 is 160. He spending 160,000 to get only 100,000. So automatically he will not obtain education. Why he need to obtain it? If he obtain it, he will spend 160,000, but he get only 100. That means he lose 60,000. So we say group 1 will find that education does not pay and will not obtain any, whereas people in group 2 will find that education does pay and will obtain the level Y of equal to 4, because why? 20,000 times 4 equal 80,000. 80,000 He spent, but he's going to get 100,000, so he will benefit 20,000. So with high productivity, they should obtain education of 4 years because it will cost them only 80,000 and they are going to gain 100,000. This with low productivity, they should not get it because once they get it, they need to spend 160,000, but after they get it, will benefit only 100,000. So now when the firm interviews job candidates who have no college education, it correctly assumes they have low productivity and offer them a wage of 100,000. Similarly, when the firm interviews people who have 4 years of college, is correctly assume their productivity is high, warranting a wage of 20,000. We therefore have an equilibrium. High productivity people will obtain a college education to signal their productivity. Firms will read this signal and offer them a high wage. This is highly simplified model, but illustrates a significant point. Education can be an important signal that allows firms to sort workers according to productivity. Some workers, those with high productivity, will want to obtain a college education even if that education does nothing to increase their productivity. Why? These workers simply want to identify themselves as highly productive, so they obtain education needed to send a signal. But in real world, of course, education does provide a useful knowledge and does increase one ultimate productivity. Otherwise, if it is not the case, why you are doing your degree and why I am here teaching you? So education, it must have that type of value to increase your productivity. So we say education does increase productivity and provide a useful signal about individual work habit, even if education does not change productivity. Then we talk about guarantees and warranties, signaling to identify high quality and dependability and effective decision tools because the cost of warranties to low quality producers is too high. And this is, for example, here we consider markets for such durable goods like television, like cameras, refrigerator. Many firms produce these items, but some brands are more dependable than others. For example, if consumers could not tell which brand tend to be more dependable, the better brand could not be sold for a higher prices. So what they do, firms that produce high quality, more dependable product must therefore make consumer aware of this difference. What they do? How can they do it in a convincing way? The answer is guarantees and warranties. And this is what we do. When we do and buy television, the first thing that we ask, how much the guarantee or the warranty, how many years? So guarantees and warranties effectively signal product quality because an extensive warranty is more costly for the producer of a low quality items than for the producer of a high quality items. The low quality item is more likely to require servicing under the warranty, for which the producer will have to pay in their own self-interest. Therefore, producer of low quality items will not offer extensive warranties. Those consumers can correctly view extensive warranties as a signal of high quality and will pay more for the product. And therefore, if you can see, if you go and buy, for example, refrigerator now, like Samsung, like Sharp, they will offer up to 12 years warranty. That it shows that that brand has very high quality of product, and you are, as a consumer, are willing to pay for that price. For example, sometimes we buy, as we say, based on reputation. I buy the television Samsung because I know Samsung is a very reputable company. But what other companies, when they just enter the market, even though they have a very high quality product, But because they still the brand is new, people they don't know that brand. They don't know have they don't the brand does not have a reputation. So that brand what they do they give lower prices with also extensive warranty. So once you find a product, for example, TV, which is half price of Samsung, and give you also the same period of warranty, you will buy it and try it. And after that few years, of course, the company will not make money at the beginning, maybe even lose the money. But after when people try it, then they understand that it has a very good quality. Then that brand will build a reputation, and you will see the price already increases. And you can see it in so many brands in Malaysia. Really, I myself, I have observed that so many brands that were very cheap, then after the price will increase. One of them is Panasonic. So I think this is for today. For next week, we will talk about the moral hazard.